Americans are running out of money, but it's not their cash in their bank account that I'm talking about. It's the ability to spend money on their credit card. Now, how do I know that? Because over the last week or so, Macy's, Nordstrom, and Best Buy came out and said that they're seeing a rise in credit card delinquencies and a decline in credit card spending. And in addition to that, just yesterday, we had the Treasury Department of the United States release a joint statement with the Federal Reserve Bank and the FDIC Insurance Committee saying that banks and lenders in the United States have to increase the regulatory requirements because of potential government seizures. And in case you are seized by the government, meaning you're a bank that goes under, you want to have some cash reserves. That way the government doesn't have to completely bail out the bank. So let me start by talking about what's going on with credit card delinquencies. More specifically, let me talk about what Macy's said last week when it came to credit card delinquencies, because what they said is that in the second quarter of 2023, they saw their credit card sales fall by 36% year over year. Now the question is, why are credit card sales falling? Well, obviously it's because interest rates are rising. And what Macy's says is that their annual percentage interest rate is now 32 or almost 32% on their Macy's card, and people are struggling now to pay back their Macy's credit card bills. What they said, here's from their CEO, quote, "While we have seen an increase in revenues as interest rates have risen, that has been more than offset by higher bad debt assumptions and write-offs." AKA, now that interest rates have risen, your credit card debt on your Macy's card, or your credit card interest rate on your Macy's card has skyrocketed. Now it's almost 32%. And that means they're making more money because now they're charging you a higher interest rate, but from a net perspective, after subtracting their expenses and bad debts, meaning the debts that people are not able to pay back, they're actually losing more money now because people are losing the ability to pay back their debt faster than their ability to pay the higher interest rates. And so this is where the Macy's CFO, the Chief Financial Officer, went on to say, quote, "These bad debt assumptions and write-offs are the result of rising delinquencies, which leads to higher net credit losses over time and contributes to increased bad debt within the portfolio." So Macy's is not only seeing people spend less money on their credit card, but now because of the rising delinquencies in their credit card payments, that is causing more losses to some of the biggest retailers in the world like Macy's, because people are struggling to keep up with the higher interest payments. But it's not just Macy's. Take a look at what Nordstrom had to say. Nordstrom had to say that delinquencies are now above pre-pandemic levels. So the credit card missed payments for Nordstrom's, which is a higher end retailer, are now higher than they were before the pandemic. And then, quote, "This could result in higher credit losses in the second half of 2023 and into 2024. So Nordstrom is saying the same thing, and also Best Buy. Here's what Best Buy's CFO had to say when he was talking about their net credit losses. He said, quote, "We are seeing a more normalized rate compared to 2020, aka over the last couple of years, we saw these delinquencies really fall. Why? Because people were getting a lot of money from the government, and people had the ability to spend, and people paid off a lot of credit card debt. So people had the ability to rack up their debt. Well, over the last 12 to 18 months, we saw credit card debt shoot back up. Now what we're seeing happen is credit card delinquencies are also rising. And many companies are now seeing these credit card delinquencies higher than where we were before the pandemic. Now, why is this significant? Because of the rate at which credit card delinquencies are rising. You gotta remember, just less than a couple of years ago, we had the lowest credit card delinquency rates ever because people were given free money, unemployment money, stimulus checks, whatever. Same with corporations, but people had all this free money, and we saw the biggest pay down of credit card debt in the history of time. Well, now we have more credit card debt than the history of time, and over $1 trillion. And we're talking about over the course of about 24 months, we saw all of this happen. So this is where now lenders are starting to get concerned, and this is where now you have the Treasury Department, the FDIC, and the Federal Reserve Bank kind of working behind the scenes to protect themselves against potential defaults in the banking sector. Now, we've been covering all of this in Market Briefs. Market Briefs is my free financial newsletter. If you have not joined Market Briefs yet, Well, it's a free and easy way for you to stay up to date on what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you want to read market briefs, I got the link for you down in the description below, or you can go to briefs.co/market. That's briefs.co/market. So now let's talk about what the Treasury Department said. The Treasury Department released a joint statement with the FDIC and the Federal Reserve Bank where they said that American banks with at least $100 billion in assets would now be subject to new requirements which makes them hold a layer of long-term debt to absorb losses in the event of a government seizure. Now let me explain what that means in plain English. If you are an American bank and you have over $100 billion in assets under management, you are now going to be subject to the new requirements set by the government, which means that now you're going to be required to keep more cash on hand. I'll read you the technicalities and then I'll explain what this means. It says the lenders will have to maintain long-term debt levels equal to 3.5% of average total losses or 6% of risk-weighted assets, whichever is higher. All that really means for you is that now banks with over $100 billion in assets under management will now be required to keep more cash on hand in reserves. The reason why is because they're worried about more government seizures. If a bank collapses, they get seized by the FDIC, the Federal Deposit Insurance Corporation, and then the FDIC has to then pay out all the depositors within the FDIC insurance range. And this is where now the government is trying to protect themselves because the FDIC doesn't have all that money sitting in an account somewhere. They're backed by the full faith and credit of the United States government. So if a bank collapses, they get seized by the FDIC. The FDIC doesn't have enough money to pay back all the depositors. So the FDIC then turns to the government and saying, hey, give us your full faith and credit. Well, the government doesn't have a stockpile of cash sitting around somewhere either. I mean, if they did, they wouldn't be in $32 trillion of national debt, and we wouldn't carry an annual national deficit every single year. And so where does the government get their money? Well, then they go out and borrow this money, or they work with the Federal Reserve Bank to print this money out of thin air. So now, if a bank collapses, they go to the FDIC goes to the government turns to the Federal Reserve Bank, the Federal Reserve Bank prints this money out of thin air, inflation's created, and then this money goes back out to the depositors, which means you still pay that money that gets created back in the form of inflation. So you get your money back, but now you have higher inflation. So this is where now the Treasury Department, the government is saying, well, we don't want to keep dealing with all these seizures, maybe because they're worried about more potential government or bank collapses. And so now they're trying to be proactive. And so now they're telling banks, you're going to have to now keep more cash in reserve, which also has its own consequences. But because now let's think about this from a bank perspective. You are in the business of lending money. The more money you lend out, the more money you make. And currently, we are in a time where banks are struggling. And the reason why they're struggling is because, well, number one, people are borrowing less money along with corporations. Why? Because interest rates are so much higher. Right? People aren't buying homes the same way that they were a couple of years ago because number one, the inventory is less, but number two, because mortgage rates are so much higher. And so there's less volume of money being lent out by banks. So on one hand, banks are seeing less transactions happen, which is hurting the revenues over there. Now, the loans that they are issuing, are they at higher interest rates? Yes. But the second issue is banks are also now facing higher operating costs. These higher operating costs are now due to these regulatory concerns. So governments are saying, okay, you have to keep more cash on hand, which means you have to lend less money out. Because if more cash is sitting in a bank's account somewhere, that means that's money that's not being used. That's money that's not generating an interest. And remember, banks are, or not all banks, but some banks are now struggling because of the higher operating costs, especially post the Silicon Valley Bank collapse and all of that stuff that happened, because you saw a lot of money leave the smaller regional banks. So you have these like kind of mid-tier, small to mid-sized regional banks that saw a lot of cash leave their accounts, which means they have less ability to generate money as it is. And now less people are taking out new loans. And now the government's saying you have to keep more cash on hand, which is kind of like a pow, 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 a 1, 2, 3 punch to a lot of these small to mid-sized banks, because number one, a lot of money has already left the banks. Number two, less and less people are borrowing money from the banks. And now number three, the government saying is you have to keep more cash on hand to protect us, the government, against potential seizures of the bank. And this is where now, if you start to piece together all the different things happening in the economy, got Macy's, Nordstrom, and Best Buy coming out saying, yeah, we're seeing credit card delinquencies rise. Yeah, we're seeing less people spend money on their credit card. What does that mean? It means consumers are starting to feel the pinch. Consumers are starting to run out of money. And the money is not just the cash in their bank, it's their ability to spend even with debt. Now, still, people have access to equity in their homes, which I do not recommend you go out and spend at Macy's, but some banks do recommend that. Wells Fargo put out a piece talking about that, made a video about that. So you have banks saying, hey, people still have the ability to spend. Maybe don't put it on your credit card anymore. Maybe just dig into the equity in your home. That way you can continue spending. But if people lose the ability to spend on their credit cards, and if people get tapped out on their home equity, well, then people will lose the ability to spend. And that's where you would start to see a lot more pain in the economy. So just understand what's going on. That way you can continue to work on your financial education and work to kind of prepare for whatever might be coming. But I want you to understand what's going on the consumer side, because that's one of the biggest indicators of a potential economic slowdown, because if people lose the ability to spend, the economy loses the ability to grow.